When the United States runs a trade deficit, it's spending more abroad than it earns. For decades, the rest of the world has financed this imbalance by purchasing American assets. But on April 2nd, everything changed. With U.S. tariffs surging from 2.5% to 25%, global trade and investment flows face a historic restructuring. Through an emerging markets lens, how are these times affecting places around the world? We're going to break it all down for you right here on UBS Trending. Hi, everyone, and thank you so much for joining us. I'm Anthony Pastore, and this is UBS Trending. In the hot seat today is Chief Investment Officer of Emerging Markets here in the CIO, Alejo Cherwanko. Alejo, thank you. I know you've been busily digesting as much of the news flow as you could, especially since the tariffs announcement was instituted on April 2nd, which we all anticipated. And as we said in the intro, today we're looking at it from an emerging markets lens. And I think probably one of the things that I would ask you is explaining a trade war and really what it looks like through an emerging markets lens. Because we've talked about Europe, we talk about Canada, but there's lots of China, Mexico, India, a lot of countries, Asian countries that are very much going to be impacted potentially by the tariffs here in the U.S.
Absolutely. You said it. We anticipated Liberation Day. Nobody expected this size of announcement. It's gigantic. Mm-hmm. We're talking about effective U.S. tariff rates in the 25% realm, which is not seen in 100 years. So this is a big deal. If it sticks, we will see deep changes to the way goods flow across borders, deep changes to the way capital flows across borders. There are two sides of the same coin. If the U.S. runs a trade deficit, this means the country is buying a lot more goods from abroad than it's selling abroad. In other words, like any family corporation that is living beyond its means, it needs financing. It needs people to plug that gap. For decades, foreigners were happy to provide that financing in the shape of buying U.S. assets, U.S. stocks, U.S. bonds. Now, if the United States wants to eliminate this trade deficit, then capital might not flow as freely across borders. That's another implication.
Yeah, which impacts everyone, literally around the globe, us and our trade partners, whether they be developed or, in this case, emerging. But we can't really not focus on Asia because Asian countries seem to have really bared the brunt of these sweeping tariffs, and by huge numbers. We know that the effective rate for China is something like 54%, but and interestingly, I saw an article talking about how China is getting together with South Korea and Japan to figure out a coordinated tariff response. So clearly they are planning on saying something or coming up with some plan or a retaliation or a reconciliation. But what do you expect to hear from countries like China and the other countries that are in the Asian region?
You're right. Asian countries have been affected the most. China is in the eye of the storm with an effective rate, as we speak, of 54% or maybe more, given retaliatory dynamics, right? But it hasn't been only China. It's been the China plus one set of countries. A lot of manufacturers over the last few years have diversified away from China and expanded capacity in Vietnam, in Thailand, in Cambodia, right? All of these additional markets are feeling the heat of significantly higher tariffs. Mm-hmm. This is not going to be an easy adjustment period for Asia, but make no mistake, policymakers are going to ease monetary policy, fiscal policy, and try to help their economies adjust and redirect resources. Importantly, towards the end of this month, we've got a leadership meeting out of China. The Politburo meeting is taking place, and we will see a lot more details about just how aggressively Chinese policymakers are going to ease.
And you even write in your recent Emerging Markets monthly publication that Asian economic growth could decline 1 to 2 percentage points, dropping below 4%. And it was 5.1% in 2024. That's significant.
It is very sizable. It goes to show the global implications of this decision. And once again, if these tariff rates stick, they stay at these levels, we might see a global economic impact with activity coming down across every single region.
Right. When we started off after the inauguration, the first three countries we heard mostly about potential tariffs were China, Mexico, Canada. So let's switch over to North America.
What a change.
What a change. It went from three countries to almost every country. So that, obviously there was shock when people saw that giant list that they were holding up at the White House on Liberation Day. So let's talk about Latin America specifically, because including Canada in that, just in this description, Canada and Mexico really were spared the brunt, as we're saying, contradictory to what we thought would happen because of the USMCA, which covers a big portion of exports to the US. But with other Latin American countries, they seem relatively insulated a little bit. So what's the economic impact for Latin America overall?
For starters, the fact that Canada and Mexico were the only two countries globally to be excluded from that April 2nd list is quite notable.
That's right.
And it points to maybe the emergence of a fortress North America trade bloc, right? Time will tell. We'll see if there's additional changes. But for now, this seems to be a policy priority. You cannot fight everybody at the same time. Mexico and Canada can be part of the solution rather than become part of the problem. But more broadly, in Latin America, it's been quite shocking that every Latin American country was tariffed at 10%, the lowest of any other tariff rate out there. And so you're starting to see some headlines, such as Apple exploring the possibility of expanding production in countries such as Brazil. This is not surprising. People are trying to find a way around these new restrictions, right? And so when you think about how cheap Latin American stocks, bonds, and currencies already were, plus the fact that they weren't that affected by tariffs, the region emerges as a relatively safer haven in this time of turbulence.
Investment-wise, is that an opportunity then? Would you then, basically the question is, what are you recommending as somebody who is covering emerging markets? Clearly, given that there's more tariff percentage on Asian countries versus Latin American countries, where do you see the most investment opportunities right now?
Look, for starters, if your portfolio is too geographically concentrated, we think that's a mistake. You got to spread your exposure across the Americas, Europe, and Asia. If your portfolio is too concentrated in a single asset class, think about stocks. Don't forget, you got to have bonds, you got to have alternatives. And in addition, I think this is time to think broadly and consider new asset classes in your repertoire. I'm thinking about gold. For instance, we think this is a very interesting portfolio hedge diversifier. So I think you gotta think broadly, and whatever recipe has worked for you over the last 15 years, it's unlikely to work again given how much is changing.
Yeah, gold is an interesting commodity, as we've seen. It's held up very well comparatively. Obviously, there was some profit taking perhaps going on because it did do so well since the beginning of the year and even last year. But obviously, there are some good hedges out there, as you described, that are part of our house view and CIO. Before I let you go, though, Alejo, one of the things that keeps coming up is we're hearing more of our competitors, like Goldman Sachs, for example, raising their potential outlook on a recession. Today, now they had it at 45%. And I've seen other reports that other banks and financial institutions are increasing their recession risk. If the U.S. does go into a recession, what does that do for potentially the impact, or what kind of impact does it have on EM?
Look,
and is it a country by country story, or is it a blanket statement?
Let me start by saying, why is it so hard to predict a recession or lack thereof in the United States? Because it really all hinges on tariff outlook. And this can change on a dime, right? One day we get one headline, the next day we get a different headline. So, pounding the table, there's going to be a recession, there's not going to be a recession. It's almost impossible in the context of so much change and uncertainty. Now, if the U.S. were to go into a recession, it's the largest economy in the world. It imposed tariffs of a significant size in the second largest economy in the world. So this would be a very severe environment. This calls for patience, investing in alignment with your long-term goals, but it's not going to be an easy period.
Right, and we have seen, you mentioned, there's a lot of headline risk out there, and you might see a headline that looks in favor of putting a pause on the tariffs, and the markets all of a sudden shift directions with the wind, but then something else comes out and says, no, that's not a real headline, and then markets go down again. So we really are seeing these immediate reactions to news flow. So I think it's all about staying calm, staying the course, working with your advisor, and as you mentioned, having a well-diversified portfolio within EM and then outside of that is really a way to feel like you can go to sleep at night and have a little bit of, you could breathe a little bit knowing that the diversified portfolio you have is going to protect you as much as it can. Anyway, thanks, Alejo. Always good to see you.
Thank you for having me.
Lots happening in the EM space, clearly. I mean, a lot of these countries that we're talking about don't get mentioned very much, but now they're becoming, headlines. So we'll have to keep track of that and keep in touch with you. Thanks, Alejo. Good to see you.
Thank you.
Great. Alejo Cherwanko from the Chief Investment Office. And thank you all for joining us. For more information on everything that's coming out of CIO and UBS at large, you can visit our Insights website at ubs.com/views. That's our Insights page again. And you can also follow UBS on social media. We're on LinkedIn, Facebook, as well as Instagram. Follow us at UBS Trending. Lots of studios content there for you. And look, as we say all the time, and it's really important these days, make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. See you soon.